The idea is incredibly seductive. Your money works hard in the stock market while you sleep, travel, or spend time with family, and in return, it sends you a steady check every single month. This is the dream of passive income from stocks. But for every person who has genuinely achieved this, there are thousands more who are sold dangerous get-rich-quick schemes that blow up their accounts. So, what does legitimate, realistic passive income from the stock market actually look like? Is it even possible for the average person? The answer is a resounding yes, but it requires a specific strategy, a significant amount of capital, and a complete shift in your investing mindset. Today, we're cutting through the hype and outlining the 3 most practical and proven methods for generating cash flow from your stock portfolio. We'll talk about the king of passive income, a more advanced tactic, and the simple strategy everyone forgets. The first and most popular method is, without a doubt, building a portfolio of dividend stocks. This is the classic approach to stock market passive income. You are essentially becoming a part owner of profitable, mature companies that share their earnings with shareholders on a regular schedule, usually every quarter. Your income is generated by these dividend payments depositing directly into your brokerage account. The strategy here is to build a diversified portfolio of these income-paying companies, often focusing on sectors known for stable dividends like consumer staples, utilities, and real estate investment trusts, or REITs. The goal is to amass a large enough portfolio that the combined quarterly dividend payments can cover a meaningful portion of your living expenses. An insider secret to supercharge this strategy is to use a dividend reinvestment plan, or DRIP. During your accumulation years, this means you automatically use the dividends you receive to buy more shares of the stock. This harnesses the power of compounding, dramatically accelerating the growth of your income stream over time. Once you're ready to live off the income, you simply turn the DRIP off and start taking the cash. The major advantage of this method is its simplicity and predictability. The downside is that it requires a substantial amount of invested capital to generate a significant income. And there's always the risk a company could cut its dividend during tough economic times. The second method is more advanced and involves using stock options, specifically a strategy called selling covered calls. This is how you can generate income from stocks that don't even pay a dividend. Here's how it works in simple terms. You must first own at least 100 shares of a particular stock. Then, you can sell someone else the right, or the option, to buy those shares from you at a specific price, called the strike price, within a certain time period. In exchange for selling them this right, they pay you an immediate, non-refundable cash premium. If the stock price stays below the strike price until the option expires, the right becomes worthless. You keep the premium as pure profit, and you still own your shares. You can then turn around and sell another covered call, collecting another premium. It's like collecting rent on your stocks. The income from this can be much more frequent than quarterly dividends, sometimes generated weekly or monthly, however. This is a pro-level strategy with significant trade-offs. The biggest risk is the opportunity cost. If the stock price skyrockets far above your strike price, your shares will be called away, meaning you'll be forced to sell them at that lower, predetermined price. You'll keep the premium and your profit up to the strike price, but you'll miss out on any further gains. This strategy requires more active management and a solid understanding of options, so it's not for absolute beginners. The third method is often overlooked because it seems too simple, but it is incredibly powerful and reliable: systematic withdrawals from a growth portfolio. You don't necessarily need dividend stocks or options to create passive income. Imagine you have a portfolio invested primarily in growth-oriented assets like a broad S&P 500 index fund. This portfolio is growing in value over the long term, but it doesn't pay much in dividends. How do you get income from it? You simply sell a small, calculated portion of your holdings on a regular schedule. For example, if you have a $1 million portfolio, you might decide to sell 4% of it, or $40,000, over the course of a year. You can set this up to happen automatically, transferring the cash to your bank account each month. This is a completely legitimate form of passive income. The key to making this work long-term is to keep your withdrawal rate low enough that your portfolio's overall growth rate outpaces your withdrawals, allowing your principal to continue growing even as you take money out. This is the foundation of many academic retirement models, like the famous 4% rule. The advantage of this method is that it gives you total flexibility to invest for maximum growth without being limited to dividend-paying companies. The disadvantage is that you are periodically reducing your share count, and during a severe bear market, selling shares can lock in losses and harm your portfolio's ability to recover. Before we conclude, a critical reality check and disclaimer: the word passive is a bit of a misnomer. While the income arrives automatically, building the portfolio requires active saving, investing, and monitoring. More importantly, generating meaningful income requires a substantial amount of capital. To generate just $1,000 a month from dividends with a 4% average yield, you would need a portfolio of $300,000. All of these strategies carry market risk. Your capital can decline in value, and your income stream is not always guaranteed. This video is for educational purposes only and is not financial advice. Options trading involves significant risk and is not suitable for all investors. You must consult with a qualified financial advisor to see if these strategies are appropriate for your situation. So, to build a passive income stream with stocks, you have 3 clear paths. You can build a dividend portfolio for steady, predictable payments. You can learn to sell covered calls to collect premium income from stocks you already own. Or, you can simply invest for total growth and systematically sell a small percentage of your portfolio over time. The best path for you depends on your risk tolerance, the amount of capital you have, and your willingness to learn more complex strategies. The best path for you depends on your risk tolerance, the amount of capital you have, and your willingness to learn more complex strategies. The best path for you depends on your risk tolerance, the amount of capital you have, and your willingness to learn more complex strategies. The common thread in all of them is the requirement for discipline, patience, and a long-term perspective. The common thread in all of them is the requirement for discipline, patience, and a long-term perspective. The common thread in all of them is the requirement for discipline, patience, and a long-term perspective. The common thread in all of them is the requirement for discipline, patience, and a long-term perspective. The common thread in all of them is the requirement for discipline, patience, and a long-term perspective. Start by focusing on building your capital, and income will follow. Start by focusing on building your capital, and income will follow.